Hello, this is Jim Riggio. Today is Monday, and it's time for the Monday Market Muse. Before we get started, just a quick disclaimer. Capital Discussion is not a broker-dealer or registered investment advisor. The presentation that you're going to see is for educational purposes only. The situation that you may end up being in terms of risk, we don't know, so we have no idea of knowing if any trade that we talk about is appropriate to you. Options trades have substantial risk. You should end up reading the risk disclosure from the OCC before making any trades. Hypothetical or simulated trades, are believed to be accurate, but your profits, or losses will vary depending on factors such as liquidity, slippage, and commissions. And with that, what I'd like to end up starting with, we're down today about 15 points or so in the futures. Excuse me. I always like to end up taking a look at a big picture first. If I end up taking a look at what we look like on a monthly level, because I want you to see where I actually end up drawing some of my trend lines from. Anyway, you can end up seeing I'll end up drawing trend lines, long-term trend lines going back to 2008. You can see where the lines are. You can see where the monthly is. This Fibonacci basically started from the run-up in 2014. Then when we had the oil sell-off, you'll end up seeing, and also for the last year and a half. Let me take this and just modify what we're looking at here. Okay, so over the last couple of years, you'll end up seeing, this was the big sell-off when we ended up thinking that the Greek debt crisis was going to end the world. This was the big oil sell-off that we ended up having. This was Brexit, and here's where we are right now. One of the things I want to end up pointing out is something my friend Andy Fishman and I, who hopefully will be joining us out later. He's on a conference call with one of the larger companies that he owns, or stockholder of, is these particular gaps. I wanted to point them out because the thing is that they have not filled. If you go back in the history of the SPX, maybe you get one unfilled gap every couple of years. We've had three. We just had this one filled. Up here, this latest one. So I want to end up kind of pointing out what's happened this year, so it's a little bit easier to see. The fact that we had this market run up, and over here you can actually see there was a place here, and before the other day we had a double gap. This morning we actually have a gap down. They're smaller, but you can end up seeing what's happened here is that definitely we tried to end up making a break back up, but we've had some weakness the last couple of days. One of the things that I want you to end up seeing is that this line, I don't know if you guys remember where this line came from, but this was a high that we ended up having back in 2014, and then there was another one, and you can end up seeing each successive high that ends up acting as support or resistance. I'll end up drawing. This was a particular one at 2120. You can end up seeing here that it ended up acting as a neckline. We tried multiple times. We couldn't get above it. Over here, it acted as resistance again. It acted resistance. Then when we got through it really hard, and then it acted as support. So this 2120 line, I think is, very, very significant, even more so than the top of the range that we ended up having. So if I come back over here and we take a look again. If we end up selling off, these will be our first two resistance points, and there'll be support levels. There'll definitely be significant support levels. But if we do break them, I think that the next real support level will end up being trying to fill this gap. So what I had mentioned to the Kevlar folks is that I ended up looking at this. I look at it that we're risking, trying to make one if we move up versus maybe having a risk of 6 if we go down. So we have an asymmetrical risk at this point. So I'm really concerned. Can this end up coming back and being support and bouncing up? Without question, it would be very healthy to end up doing that, especially if we had multiple times when this 2120 line ended up holding. I just don't know what ends up happening here. You can also end up seeing the long-term trend line is also coming up that ends up having a support line. And this was basically from the bottom that we hit back in February, the bottom of Brexit, and then the line continuing to move up. So that's where I am. I am concerned about the downside, but first we'll end up seeing where we are if we end up holding support. What I wanted to end up showing you next was that I look at a number of different things. These are the oscillators that I end up taking a look at. Okay, and again, let's take a look at the more recent term. You can end up seeing here that we ended up having the sell-off, okay, a couple of Fridays ago. We've ended up definitely picking up the range or the length of the bars. You can see that we're going to end up getting into that more in a couple of minutes. But we definitely ended up finding that the 100-day was working at support. One of the things I take a look at all the time is that I don't really look at any specific moving averages. I think that anything that people, I'm saying, well, I find that the 89-day average works much better than the 100-day average. Yeah, it's going to sometimes it's not. So I just take a look at the major ones and seeing which ones are currently working, because they almost become like self-fulfilling prophecies. Not that I feel very strongly that one will end up working over the other. I'm just trying to see where will the bots be trading more? Where will the bigger money start to end up coming in? They're going to take a look and see where the support ends up being. Okay. You can end up seeing that the faster moving, oscillators, things like the CCI, Williams percent R, and the RSI, they all started to end up turning down here. They had tried to move up. Now, here's the really interesting thing. If you take a look at Williams percent R and RSI, and even CCI, I'm pretty fond of these three, because the thing is that I think that they give you a reasonable, viewpoint on where we are. You can end up seeing what's happened here is that they were trying to move up after this little move, but they kind of ended up failing, and they've started to end up coming down. Things like the stochastics move a little bit slower, and the slowest of moving is the MACD. Okay, when I take a look at some of the momentum. Okay, the DMIs are something that I tend to end up looking a lot at, and you can end up seeing here again that we've gotten a sell signal when you take a look at the DMI stochastics. You can end up taking a look at some of the moving averages behind here. So again, there's a bit of an air pocket if we end up going below these lows. And I'll just get rid of that one too. Okay. I wanted to end up actually showing you the charts on LiveVol. And the reason why I want to end up using LiveVol is that I know a lot of folks end up using Thinkorswim, so I'll use the charting patterns there. However, I like to end up taking a look much more so at the volatility as we move further out in time. Remember, there's two things that we end up taking a look at. You can't look at volatility as a single number. So what I take a look at, and this one is easy for everybody to see on LVX, is that I can take a look at implied volatilities at different days. So remember what the VIX formula basically is doing. It's trying to give you a 30-day volatility number. So what's the IV 30 days out? And it always does that. So it's kind of a rolling average. So what LiveVol's done is that they've given me a rolling average of IV of 30 days. And I know you can get that on Thinkorswim and a lot of other places. But they also give it to me at 60 days, 90 days, 120, 180, and 360. One of the things that you can end up seeing that ended up happening is that with this recent sell-off, and let's go and just take a look at the last 3 months. The 30-day volatility has really, really come in. I know some people would rather end up looking at this, and you can end up looking at this on the VIX futures. VIX Central is a good place to end up looking at this if you want to. I tend to end up liking to see my curves and where they are on a regular basis. It was interesting to me that the 60-day volatility had kind of popped up, and you know what? I'm already getting into my Apple trade, which I was going to do next. So I'm sorry. Let me do this. I wanted to start here. Okay, you can end up seeing how volatility popped up on all three. What I'm looking at now is, and I apologize for that, this is the SPX. You can see how the volatility popped up when we ended up having the sell-off last Friday, when we ended up having the run-up and we started to move up. It wasn't until the second run-up where we had the volatilities start to end up coming down. Okay, that was on the SPX. What I wanted to end up showing you is a trade that Andy Fishman, okay, who hopefully will be able to end up joining us in about 20 minutes or so, ended up putting on. There was a lot of news in and around the iPhone 7, and after doing a ton of research, Andy is much more a fundamental guy. After doing a ton of research, he ended up coming to the conclusion that the iPhone 7 may not end up having the same level of sales that previous iPhones have. Their improvements at this point are becoming more incremental. The fact that they start making some of the major announcements, things like the aperture, the new phone buds, okay, which earbuds that some people may or may not like. It's been a bit of a concern. We took a look at some of the channel checks, and this is all Andy's work from a fundamental point of view. And so, from a fundamental point of view, he ended up coming back and saying, "Hey, I'm a bit concerned here." So what I started to take a look at was that I started to take a look at, well, what do we look like on the shorter term volatility? Now, it's interesting that volatility has really popped up, okay, in the last couple of days here on the short term, on the 30-day. So more and more people are becoming concerned. Now, remember, earnings are coming up for Apple, right? Their next earnings, okay, we end up expecting to end up being, and I don't have them up here, but usually in October, they're in the, somewhere between October 20th, October 24th, and somebody I know will end up putting in their earnings. I had it up, sorry, and I ended up closing it beforehand. So what I looked at was a longer term play on Apple, okay? I wanted to end up being somewhat short on Apple. So after looking at the different volatilities, I also ended up noticing that the trade of being short the 60-day volatility, because it kind of popped, and being long the 120-day volatility looked really nice. Okay, let me get this off here. Right, this looked like a really nice play. The challenge, okay, is that, and this is a great example that I want all of your options guys to end up taking a look at. The challenge with something like this is, why did it happen? Okay, what's the reason? Many times people rush into a trade like this and say, "Oh, look at this! I have a competitive advantage, so therefore I'm going to end up definitely running into a trade like this." Well, it turns out that not only did this end up selling off somewhat here, but the 120-day is the January expiration, which will most likely be before earnings for the end of the year. Okay, the 60-day is the earnings right after next quarters. So, of course, the volatilities in the quarters that, or the options expirations that include the earnings will end up being higher. The ones that expire right beforehand wouldn't be. So if I take a look at something like, do I do a 30-day and not 120, but let's go a little bit further out. I like a trade like this, okay? And when I took a look at it, I'm going to end up actually showing you some things on Apple. I can end up going through other trades if people end up wanting. I don't have the chat up. Let me have the chat. This was one of the ones that folks ended up saying to me, "Hey, Jim, can we end up taking a look at some trades?" When I get emails, I'll end up taking a look at this. This was one that, and let me detach this. This was one where, like I said, we ended up looking long and hard for different trades with myself and Andy. Andy and I used to end up being, for those that you don't know, and hopefully, like I said, when he comes on a little bit later, I'll introduce him. But Andy and I were, oh, Andy, you are here. Wonderful. I originally met Andy. Andy, I don't know if you remember this. I met you in a bar with some mutual friends. just east of 1 on Palmetto in Boca Raton.
I recall.
And
I think my friend was back.
and Andy at the time was a relatively newly retired, Merrill Lynch guy. Andy retired at the tender age of 36. He began as an analyst, and then he ended up moving over, and he became an advisor. Andy, why don't you tell us a little bit about your background?
Well, you pretty much sort of said it. I am the son of a stockbroker. I started on the fixed income side of the business on Wall Street. I later joined my father in his practice. He got ill. I took it over. I grew it. And I guess putting it tactfully, I grew disenchanted with Wall Street. So I abandoned it and refused to work for any of the companies.
And so Andy sits at home and manages his little 8-figure account and lives rather comfortably, I would say. About 4 years ago or so, Andy and I started to end up working together. It was to put together a hedge fund that we were running together. A bunch of different things ended up happening. Some guys from Goldman Sachs came in, and we kind of ended up merging our stuff with them. But we've never stopped working together. And we'll end up talking about trading ideas all the time. We'll end up going over charts. So, Andy, would you tell us a little bit about how you arrived at the fact that you thought that Apple was a short? And if you want, I'll end up bringing up some of the Apple charts.
Well, I'll say this carefully. They're reporting in the news that those who have been long short this year aren't doing so well. And although I do a good bit of shorting, I haven't done a lot this year, so it's helped me to not fall into the same trap as others. So although I'm short Apple, I'm not short anything else in my portfolio. Is on average long. And that's based on my belief that you're going to continue to see every country on earth keep printing money and giving it away, which is why I don't ever keep money. Regarding Apple, it just seems like there's been a tremendous amount of hype here. I kind of wonder if this was going to go to the moon if Cook wouldn't have sold as much stock as he recently sold. So it just seemed like a decent time to put out a short, for better or for worse. The chart has more holes than Swiss cheese.
And why Apple, though?
Again, it's just really based on the hype. I like to try and use other people's marketing budgets to my own advantage, and it sure looks like there's been a hell of a lot of money spent on bringing Apple stock up here.
Yeah, one of the things that we ended up talking about, Andy and I did, we're a big believer in holes. And I haven't drawn them here, but you can definitely see that there was a gap, back in March of 2015 where we ended up coming up here, back below 80. This was the one that really, really got us, though. If you take a look at this, this is a gap, ended up holding support. And let me make it bigger so everybody can see. Okay, there was a gap down. Okay, came back up, ended up being resistance, came up, was resistance again, then we gapped over it. So this is a gap that has lasted multiple times in this 101 range, 101 to 102 range. We also have a gap over here in the 106 range. So we look at it and saying, I know that if you go back in the history of Apple, there are some gaps. Okay, you can go back and find a gap at between $1 and $2. Okay, if you go back far enough, and there are other gaps to pull away. But these are ones that, with the hype of the iPhone, Andy and I have even done this. Andy more so than I have. But over the last week, I know that Andy's gone to a couple of Apple outlets just to end up watching how many people are buying the iPhone, and the answer was not a lot that we've seen. Okay, I went with him yesterday. No, we went to the Boca.
We didn't really see anything selling in that store. That's the reality. No. There were people there, but when you take out employees and you take out those people getting their things fixed, and you take out the kids playing, we didn't really see a lot of commerce going on.
Right. We just watched how many bags came out.
Bags.
Yeah. Right. We sat there and we judged how many bags were coming out of the store. And so we kind of take a look at it again. We're looking for asymmetrical risk, right? Where we can end up risking one to make, two or more. And this is one where if we go up, we have multiple levels where I can end up drawing support. But I think that, coming down is a reasonable, risk reward ratio at this point. So what ends up happening many times is that Andy will end up doing all the fundamental research. We'll sit down. He'll take first cut at technical analysis, then we do it together, and then I'll sit down and I'll do the options trades. Okay, so it's a system that we've had, and it's worked out rather well for us.
Put another way, when I'm pretty sure I have something special, when I'm considering making a large investment for me, then I call in the smartest guy I know, which is Jim, just to make sure I'm not insane, and to see if by chance he sees what I see.
Yeah, we've had this conversation. Now, the two aren't mutually exclusive. Just because you have a good trade doesn't still mean that I don't think you're insane.
Fair enough.
So anyway, what I'll do is I just wanted to showing you that one. Okay, there's one of the gaps, and here was another one of the gaps.
The one you really liked was the 102.
Yeah, that's the one that I do. I really do like.
It's like a buy one get.
It really is. It's to me, it's almost like BOGO at its best. Oh, and I'll just get rid of that one. Anyway, so let me get this rid of this. And what I wanted to end up doing is that I wanted to end up showing you the trades that I ended up having for looking at Apple. Okay, again. Knowing that we have two earnings for the next two earnings plays, that's the trade that I was basically looking at. Okay. And so, Andy's a equity guy, so Andy does this simple. He just ends up shorting Apple against the rest of his portfolio. By the way, always something that I've seen Andy do that a lot of other folks don't end up doing, especially almost no retail traders. Andy, I don't know if I've ever talked to you in the, whatever it's been, about 12 years that I've known you, where you have been 100% long or 100% short. You'll normally be long, okay, but you'll always have shorts against it. Is that?
Well, first and foremost, there are rules of my business as a financial advisor. I just can't stress to people how important controlling risk is. I'm in a position, unlike most people, where I can do things you're not supposed to do. And I don't suggest people follow me, and I've seen people try, and I've seen them get hurt. Sometimes, frankly, I'll short just to raise capital to go long something that I'm pretty certain is going to kick its butt. However, if you're wrong, you're hurt. So simply put, right now we're about to change presidents. The first year of a new president is historically not a great one. The market just had a lovely rally last week on the back of all the Fed governors of the world. Just didn't seem like the worst time in the world to put on a little protection, so to speak. I tend to carry a margin balance, although ultimately I'd like to see it go away. I've lowered it a lot. And, if by chance the market goes down, I'm sure my longs would be affected by that. And I wouldn't mind if my debt, so to speak, was affected by it as well. Meaning if my longs go down, I like the idea of my debt going down with it.
It's a very, very fair point.
But I just can't stress enough how experienced you need to be with everything associated with the markets and finance to do what I do, because I've seen some of the smartest people I know try, smart attorneys, smart doctors, smart whatever, but I guess it's just not the same as doing this your whole life like I have.
One of the things also that I've seen you do that a lot of people don't do is that you segregate your money more so. You have a pool that is invested in real estate. You have a pool that is invested in pretty solid fixed income type things, including dividend-paying stocks that are beaten down. Would you just talk a little bit about how you go about segregate? And then I know you do have your large stock portfolio. Could you talk a little bit about just your approach towards that?
I mean, I guess I just want to kind of say again. I certainly know the right thing to do in most situations because I've done it for so long. But sometimes I'll choose not to do the right thing. Jim recently saw me find a stock, literally just find one, I started researching it, and within a month, I own over 1% of the company, and I'm just so smitten with it, it's ridiculous. And that was just out of nowhere. So, I guess the best advice I would give to anybody is the best place to keep your money is where you would want to invest it if you had it in cash. I do think that, I don't know if there was a pretty famous money manager back in the day, and he said something like, look, you run a stable of racehorses. You got a horse in the barn that's been wonderful, won like crazy, but slowing down now. And there's a new one outside the barn that's fast as can be, a hell of a lot younger and more likely to win. Well, you have an obligation to see to it that the older winning horse has a nice retirement and the new one's put in. And managing money is the same way.
It's interesting. Andy's never met Scott Sheridan. Some of you guys may know Scott Sheridan. He, along with Tom Sosnoff, were the co-founders of Thinkorswim. One of the things that Scott Sheridan used to end up saying all the time is something that Andy just said. Andy just said, you have to end up thinking about if your money was in cash, what would you want to end up doing with it? Scott used to saying, if you had to rebuy your position, would you buy that position today?
I would buy my entire portfolio today.
And Andy, you do that every single day, okay? And I know you do, okay, because we've talked about this. You take a look at it. It's not like I've never seen Andy sit there and hope. Oh, it's gone down. I hope it comes back. Oh, this ends up happening. I hope.
That's not true. In fact, in every case, I'm hopeful I'm right. Although I expect to be right, but I'm nowhere near cocky enough to, when something I think is going to happen happens, I always say, I expected it, but that doesn't mean I'm not grateful.
Exactly.
A good example is this new stock. Found it.
I was going to use that.
It at 5, it's now 8, just out of nowhere. It's just boom.
Okay. Adam,
I expected it.
Let me go say, and boom, out of nowhere, it went from 5 to 8. Okay, and I was hopeful. Let me give you a little bit of background that Andy isn't sharing. Number one, I can't share the name of the stock. Okay, it's too small of a cap.
But I was thinking about sharing it too, but again, my concern would be that it would be inappropriately blown up at a not necessarily great time. I have to say it.
Exactly.
If you think I liked it last week, I like it more this week after their R&D day this morning.
So what ended up happening is that Andy will go and do research like I won't see any analyst on Wall Street do. He'll go, and no matter what the industry, okay, if it's a commodities company, he'll go and he'll do tons of searching on the commodity, the history, the pricing power, what it's used for, its new uses. He'll end up going and he'll end up actually talking to folks in the industry about things. We talked about Apple. What does Andy do? Andy will actually go to stores and watch people go in and out. Drug companies. He's got a couple of friends who are research, doctors that he'll end up actually speaking to. I've seen him call up, investor relationships and talk to the CFOs.
I'm a finance guy. I mean, I surround myself. I love biotech investing. I'm learning more and more, but I'm a finance guy. I surround myself with, PhD biotech people.
Right. And then he'll pick up the phone, and he'll actually speak to CFOs. Okay. So when I say he does his homework, I mean, he really, really, really does his homework. The other thing that I've seen you end up doing, which is not advisable for I think most people, is that your portfolio is usually narrower. Okay. I've seen, your where a lot of portfolio managers might tell you, oh, you end up needing to be in 20 or 50 different things so that if this one goes up or that one goes down. I've seen, again, this is your equity portfolio, not your income portfolio, right? I know.
And again, and I can take the risk. I mean, look, Jim's even though I probably have almost all of my money in, taking retirement stuff aside, I probably have all of my money right now in 8 things. And frankly, just 2 things make up probably 75% of that. So, again, don't do what I do because I'm in a unique position. If I lose half of my money, I don't give a damn.
Right. Right.
I will say gently that I've learned to sort of do this by working with Jim. When Jim and I work together, he sort of I got a taste for something I've never had before, which is competitive investing. You know, when you run a hedge fund, you know, your stats are put up against anybody's stats, including the people we see on television. So it sort of lit a competitive fire in me. And at the same time, the brokerage firm started telling you what your rate of return was on the statements. So I'm like, hey, this is kind of fun. And I decided to match wits with them. And frankly, I've been doing over 50% a year for a number of years. And my goal is still that for this year, although I may come up shy. We'll see. Too close to call at this point. But the risk is, I mean, to do what I do, you have to be willing to put another way. I was down 42% earlier this year. I'm up over 20 now. But trust me when I say most people wouldn't enjoy being down 42%. I didn't enjoy it, but I could handle it.
My favorite thing that Andy's saying, you have to understand, okay, Andy's approach. And I'm going to share the two that you, I, and Arlene spoke about when we were out at dinner last week. The first one was that after, I guess, at some point after 9/11 or so, okay, it's probably the first time with Royal Caribbean, right?
Oh, yeah.
Right. After, the world was fearful about terrorists, right? Everything was slowing down. It was at the point where some people were saying, I'm never going to end up doing anything again where I can end up being, the victim of a terrorist. And one of the biggest things in fear.
They invented an expression which we use daily. We were cocooning. That was what we were told that we were doing and should do.
Right. And one of the biggest, the biggest sitting targets were cruise ships, right? I mean, cruise ships could end up being blown up at sea. Everybody would end up dying. So nobody was ever going to end up taking another cruise as long as they lived. Right when we were in the middle of that big cocooning phase, Andy ended up going, in one of, he talks about how he gets very concentrated. He was very concentrated in Royal Caribbean.
I bought the stock hundreds of times during that period, and I did actually call the CFO. I ended up speaking to the CFO of Royal Caribbean. Great story. I said, look, I'm comfortable as hell. I'm buying living daylights out of your stock. My clients are crapping their pants. What do you have to say to them? And it was a woman, and she says, well, just tell them very simply that when our ships leave and then they return, they're sitting lower in the water by about 3 feet because of all the gold that our passengers just transferred to us. That was her way of explaining how very profitable the cruising industry is. And the stock went from a low of what was 6 to probably 70, and the dividend yield, which just kept going up, was just insane. And I still own some to this day, and I still trade it to this day, and I kind of even like it a little bit here, but I like it a little lower better.
Yeah, my other favorite one was that when we were all, we had finally had it and we couldn't watch our televisions anymore after weeks of the BP oil spill in the Gulf, especially living here in Florida, where every single night on the 6 o'clock news, they would be taking the birds out with all of the oil, and BP stock was punished beyond belief. Okay, it was after it got beat up. Okay, and by the way, we'll talk about early Andy. Early Andy started to buy, and did he buy a little bit too early? Yeah, he did. But did he continue to end up buying because he had a plan? He never goes all in. Okay, with the push of a button. He ends up just building positions. And is he early? Sometimes, yes. Does he continue to end up buying it, as it goes down when he's done his research and he's done everything? Yes. I like Andy's expression. Andy has told me that some of his most profitable positions have been when he's been in the fetal position under his desk with urine streaming down his lane because he's pissing in his pants, that he's so scared, and he reaches up and hits enter one more time on the buy button.
With the shaking finger that probably misses
Okay. But the thing is that he does this after he's done his research. And when I use the word hope before, there's no hope. Okay, you don't go into a stock with it being, with your main strategy being hope. Of course, you hope it goes up.
But I mean, in the case of BP, that was, I literally used the expression free money because that's what I felt it was. That was just, in my opinion, that was just free money. I mean, I don't even think hope played a role there.
Right. And the thing is, you were down, right? You started getting in. Tell people when you started to get in and how much further it went down.
bought my first bid at 37, which I thought was cheap. Bought my last bid at 27, at which point my hair was sort of standing on end, but that was obviously among, all of them ended up profitable, but obviously the lower ones, the most profitable.
And how high did it get when you started to unload and then when you finally finished unloading it?
It went up to 60, but it happened pretty quick and paid a nice dividend as well.
Okay. Do homework. That's the most important thing here. Do homework. So we've done our homework.
And the other thing also is, leave room to be wrong. Jim really hit the nail on one thing. As a stockbroker, when I was at Merrill Lynch long ago using an old term, commissions weren't cheap. So having the ability to dollar cost average was not the cheapest thing in the world to attempt. But at $5 a trade or even less, hell, you should see how many times I buy a stock. Some of my positions have so many different lots that, frankly, the computer systems with the firms I work with can't handle them. It's just abnormal that somebody would have bought something 500 times. But I will.
Right. It's also very, very important, okay, because Andy ends up realizing that, when we're trading these days, we're trading against computers. And large lot orders, okay, are difficult to end up getting filled. We've talked about other things, okay, about trading against the bots and the high-frequency guys. The smaller trades, okay, let Andy build rather large positions in things that aren't super liquid, but he does it over time. Okay, again, very, very important.
But bear in mind, I'm at an advantage. I'm home. I'm bored. I enjoy this, so, I'm in front of the screen a lot. People that have other jobs don't have the same flexibility, but can certainly achieve the same thing.
Yeah, no, I think very, very true. It's funny. It's like, Andy, I don't end up telling you this, but when you end up having a new idea, okay, and you end up asking me about something, I'll end up always giving you your answer about what I think about technical stuff, but I give you at least a month head start. Okay. Why? Because I know you're early, Andy. Okay, you did the homework.
I tend to be.
So anyway,
this biotech stock I recently bought, all of the executives were like scratching their head why their stock wasn't higher. I show up, I speak to this guy, I tell him I've examined everything about his company, and I love it. The only thing I haven't looked at is the science they're working on, and this guy's like, "Are you for real? That's what biotech companies are all about." And I'm like, well, I'm getting to that part. I just start with other stuff. And what I see in other stuff is great. And then I studied the science. It was great. And, the guy's like, I literally wrote the guy. I'm like, hey, I own 1.5% of your company. He texts me back. He's like, you're amazing. And the next thing you know, that value was put back on. And I'm sure all the executives are quite pleased today.
Yeah.
Every situation is different, but, doing research is important. And more importantly, controlling your emotions is important. Again, I'm serious when I suggest that there's a stream of urine running down my leg when I find myself adding to a position I've been wrong on in the near term. And I'm serious when I say my finger shakes. But I'm also serious when I say that I have enough experience doing this that I know that those are probably the most lucrative purchases or shorts I'm ever going to make in my life. And that's just through sort of knowing myself, and experience, whatever you want to call it.
It is so important. It is so important. One of the things that I know that I've done, Andy, and we've talked a little bit about this. When I started trading my Kevlar stuff that I have a service for,
Yep.
I know that with the S&P options, the biggest challenges are always in down markets. Always in down markets, without question. So what I ended up doing was I said, I've been doing this long enough that if the market ends up grinding up day after day after day after day, and I start my trades negative, I know that I can catch up or come close to catching up. Yeah, I'm going to lose a little bit of money, but it's not going to be a lot. And if I get any little bit of pullback, maybe I can even get out at a break even or a hair whisker of a profit. But when things like Brexit happened and the market ended up selling off, by the way, Brexit, I don't know if people end up realizing, it was the 6th worst day in terms of points on the Dow in history. Okay, that was a pretty nasty sell-off. And then we were down the next day.
But to use points and not percentages really misleading.
It is, but if you talk about Dow, okay, most of your stuff happens in 1929 or the early 30s. You know, um, it is somewhat misleading, but also the thing is that the trading is so much different. The bottom line on it was because I was leaning negative, I didn't do anything on that day. It sold off the next day, and I had to end up adjusting. Okay, the next day, which I did. Which after it bounced 3 days later, I had to end up taking it off at the adjustment to the downside off. So the bottom line is that even when we're wrong, okay, the plan is what are you going to end up doing about it? And it's different. And one of the things that I've learned a lot about, and we've shared a lot, Andy, is that the trading is different. But what isn't different is how am I going to end up going in, and what am I going to end up doing? Okay, what's my plan? Okay, and your plan is devoid of emotion. Okay, if you think that you can end up making right, if you think you can make a better decision, okay, out of emotion, you're absolutely wrong. I've seen so many emotional, money studies that show year after year that the money flow into and out of mutual funds is about as wrong as it could end up being.
The
Andy and I,
expression we used to use is when Wall Street has a sale, everybody runs from the shopping mall, which is very counterintuitive. If the local mall has a sale, everybody runs toward it. But when Wall Street has a sale, everybody runs away, except for me, of course.
And the thing is that you need to end up knowing that the markets will overreact. That's probably one of the safest bets, that they'll overreact up, they'll overreact down. A lot of people don't end up realizing, again, I'll go with points. Do you realize that 3 out of the 4 largest gains in the Dow's history happened in the third and fourth quarter of 2008? People would never ever realize. Well, what do you mean? Yeah, yes, you have huge gains, you had huge losses, and you have to end up learning how to end up trading when things get more difficult. How do you end up doing that? You have your plan beforehand. You don't have any emotion. And yeah, I want to end up going through, some of the Apple stuff that I ended up looking at from a negative point of view in terms of things that we were shorting. If I come back and let me see if I have just the chart real quick. Okay, here again was the Apple chart. Okay, what we were looking at, okay, at least what I was looking at, is that do we end up having, a covering this gap here at like the 106 to 107 and a half area. The 101 area is the area that I think that we really end up coming back to. So having said that, I started to end up looking at trades. As I ended up mentioning to you before, I ended up taking a look at, and let me just show you, it's right here. Right, I was looking at the different implied volatilities. I'm going to show them all to you, okay, about which months were where. And I definitely wanted to end up selling, okay, the options that were at the 60-day. The challenge is that that's right after earnings. So what I think I have to end up doing is I have to end up selling something a little bit earlier. I also end up wanting to end up buying January, again, because January would end up being the lowest. The challenge with the January earnings is that I couldn't end up really seeing, do I end up doing that right before the following earnings? So, I ended up, and this is why I use Thinkorswim for this type of stuff. I looked at all kinds of trades. I looked at condors. I looked at back ratios. I looked at calendars. I looked at diagonals. And what I came up with, and what I really ended up liking was, why don't I try to end up taking, because the volatility is a little bit lower, why don't I try to take advantage of what the earnings might end up looking like? Okay. With the earnings, okay, coming up, knowing when I have to end up selling. Oh, by the way, here, I'm going to end up showing you. You don't even need to end up looking at, a chart. I can show you right on the Thinkorswim piece, and this is true of all of them. But if I end up coming and I take a look at the implied volatility, look at how it goes from 21 to 28. You think there might be something happening in there. Okay, if I take a look at those things, the 28s right here, this is going to end up being after earnings. Okay, and this is going to end up right after earnings is going to be on the 28th. The 21st is going to be before earnings. Okay, you can normally end up telling, and you can see that. You can see that if you end up tracking the history of the implied volatility. I also took a look at the Januaries, right? Because the Januaries looked really nice. Okay, the problem that I ended up having here, and you can see that there's not that big of a difference. I don't know why the implied volatility won't go away. There we go. You can see that there is a little bit of a jump. Okay, it's not huge. Okay, between January and February, but when I'm looking at my pricing, it ended up maybe also if we have a bad quarter here, meaning that during the next earnings in October when Apple releases them, they'll be a lot more concerned of what will Christmas season look like for Apple. And so the implied volatility, especially after those earnings, are going to end up coming up rather significantly. So what I ended up, yes.
Just a quick interjection. I apologize. I know that you've got a good number of people listening to this call. If they all want, if they would all be so kind as sort of sharing their personal opinions regarding, are they growing a little tired of tech or electronics, any less important to them today than they were years ago? Do they care so much about the next iteration of a phone? Like, I'm just sort of curious on a macro basis if the reason why, we saw stores the way they were is because people maybe are just sort of, maybe this whole thing's getting a little long in the tooth. I'd be curious to know what your own subscribers thought.
If you would, okay, to everybody who's watching, in the chat box, just write down if you're a very bullish, neutral, bearish, or very bearish about Apple. I'd be interested. One of the other things
about tech in general. I'm just wondering if it's lost some of its luster. That's all.
Yeah, if you guys would, just feel free. Please write it. One of the other things that I'll end up sharing, also, Andy, I talked to you a little bit about. There's a forum, okay, for the paying members of Capital Discussions. It started with, I need to get a new trading PC or new computer. Okay, I've been an Apple guy. What do you guys think about this machine or that machine? And I was shocked, quite frankly. There were a number of people. Okay, I thought I was the only one. Because for one of the consulting jobs that I had, they gave me a Surface Pro 3 for a while. And I ran Windows 10 on it. I was shocked about how many other people thought that the Windows machines have gotten much better. And there were even a number of dyed-in-the-wool Apple guys that said that they would be willing to end up trading their Apple PCs their Apple MacBooks, MacBook Pros out for Windows machines. So it was really, really interesting. Just some of the comments. Apple bearish, tech not so much, likes Google, Facebook, and Amazon. Don't own Apple, overrated, overpriced, don't need the latest upgrade as long as the battery is not blowing up. Very, very good, John. Yes, okay. Okay. I take it you don't own a Samsung.
Jim, I'm going to interject one more time. I'm going to give you folks the name of this biotech, but I'm going to stress a couple of things. The first thing Jim would stress is we just had this could easily be set up for a buy the rumor, sell the news. The rumor was that they were going to have this event and good news was going to flow from it. The news is essentially that that's what happened.
Andy,
hang on.
With it up 62 cents again today in the conference, why don't we do it next week?
Well, no, here's what I'm going to say. I'll give them a symbol. I will warn the living crap out to them that it could fill this gap easily. And I will remind everybody of how small and illiquid this company is. So I just can't be more, I will be sitting with this stock for years and years and years to come. I was equally as turned on about a biotech a number of years ago, stock symbol NBIX, Neurocrine Biosciences. I've held it, as Jim's wife said the other night, gosh, you've had that a long time. And I'm like, well, it's been my pleasure. What was $5 is over $50. I hope to own this stock for a long time. I hope to look back and say, gee, what started as $5 is over $50. It seems to have that potential. However, it just had a large move. See the charts. It was gap-free until today. So would I be chasing it here? As Jim mentioned, I buy stocks a lot. If I tasted it, like if I bookmark things. So I may buy a drop of something so I don't forget about it, So I see it on my statement. So I hopefully even see a parentheses, which would be a loss, which tells me to buy more. So I'll give you the symbol. I'll tell you to research it. I'll tell you it's interesting. And I'll even tell you I don't have to warn the living crap out of it anymore because it's now a late-stage biotech. So it has biotech risk, not the same as early stage. It has stock price risk because it just went from 5.5 to 8. And the symbol is A as in alpha, L as in Larry, D as in David, X as in X-ray, and the name is Aldera. And frankly, they're just doing some really, really interesting stuff. I put it through all of my guys. I put it through all of my strains. And this thing is just interesting. That's all. I mean, there are no promises in biotech. I didn't know when I went nuts with my other biotech it was going to go to the moon. It was timed enough to, and it's not done. This one has the potential, but there's no certainty at all. You could, if their platform, for some reason, it's batting 1,000. If all of a sudden it starts striking out, you lost every penny, and I lost a lot of money. And the pleasure was mine because it's really an interesting company. I've enjoyed researching it. So
Okay.
I thank you guys for your contribution regarding technology and Apple.
Okay. Here it is. Had a big breakout. Quite frankly, if I had more trading shares, I would consider start to end up selling it because, over the next couple of days, I could probably end up buying it back cheaper.
Understood. And I do trade around my core positions. Like even with biotech, I may have a core position and put on trading shares. Even with the gap in this particular case, I'll let it back up and fill the gap if it wants to. I'm not going to play the trading game with this one. It's just too closely held by investors that are way too smart for me to try and play around with.
Right. So let me go back
I hear you and I agree with you.
Okay, let me go back and show everybody the Apple trade that because that one is more current. So what I started to take a look at, and I'm going to show you this. Some people asked to show the graph. Thank you very much for putting in the laptop for trading a forum in the chat for everybody. What I started to take a look at, I said, "Ooh, aren't these calendars cheap?" Where I would be doing the November, January. Remember, this is after the current earnings and before the following quarter earnings. So while I do have a role in it, where I'm meaning that a role is that when November ends up finishing, I can end up, buying back my Novembers and selling my Decembers, right? I do want to end up showing you what a double calendar might end up looking like. And this was one that I did end up liking, knowing that I don't have any earnings plays in it, okay? I like the 100 better than the 90, but if I'm very, very bearish, I don't want it to shoot by the 100. If we got closer to earnings, I would probably put on the 90. Right now, I think that's too cheap. I'd rather pay the 87 cents and have it look like this. Sorry, Thinkorswim is rather slow. So right now, between WebEx and everything else, I have to redraw it. And it looks something like this. Okay. I like this trade because I'm not paying a lot of extra money for it. I actually have slightly positive theta. You can see what will end up happening here as you get close to expiration. But this is after earnings, right? So you know that this line is not realistic. A trade that I actually would like better than this is actually to start to look at maybe selling a month earlier, and I know that the IV is up a little bit today, but not as much as the November after earnings. So if I bought, instead of buying the January, I bought after earnings, I bought February. Now this trade has 2 earnings rolls in it, right? And so with the 2 earnings rolls, I can end up having a trade that looks, boy, it's really slow. Okay. Check. Okay, there we go. I would have a trade that would be a lot more expensive, but I think that the 2 earnings rolls would end up making it somewhat worth it. The challenge is that I have to put a lot more money in here. Now, this one is understated because what ends up happening is that this October will end up expiring before earnings. I can end up buying it back, and then I can end up selling November, and November will be an earnings month. And then I can roll it to December, I can roll it to January. And so I would have 3 rolls, right? November, December, January, and I'd have 2 earnings plays within there. So this was actually the trade that I did put on. Okay, you can put it on any amounts that you want. I was trying to end up getting a trade that would cost roughly about $2,000 is all I was looking at. And so this was a trade, and what I'll do is that I will end up following up on this next week. Any of my Kevlar guys, if you want me to end up posting stuff on the Kevlar service, I will. It's not a Kevlar trade, but I'd be more than happy to end up keeping you up to date on it on a daily basis of what I'm doing on it. And I'll end up just playing this, okay, hoping for, again, right, I've done my homework, I've done the research, I've spoken to Andy, we've looked at the gap, and so, when I use the word hope,
and that is not a sure success.
It's not, no way is it a sure success. All I'm trying to end up doing is saying, how do I end up risking, okay, so that I have a better chance of making money than losing money? And this was a way where, in that 101, 102 range, okay, where we saw the gap, if we end up getting down there, okay, before earnings, this is going to be a bonanza, because what's going to end up happening is that I'm going to be able to buy back my October, and then what I'll do is
the others are still a value.
Right, and then what I'll do is I'll roll it out to November, okay, with earnings, okay, because people will be scared, they'll be crapping their pants, okay, if we end up losing, okay, 10 points, but now before earnings. And so what I'll do is I'll buy it back, and then maybe I'll sell the 90, okay, puts in November while still holding it. And so I'll end up playing this thing over and over again as much as I can, given where we are. So that's pretty much the trade here. Okay, for what's going on in Apple. Of course, the easier way, okay, doesn't take nearly as much work, is to do, just go out and, like Andy had done, but he had shorted, but he also talked about some of the risks and the rewards. That was pretty much it for the trade. Andy, I ended up going over the overall market, and I know that, I went over the oscillators, okay, and the momentums, just the way you and I always did. Also, the thing is that I would always draw, okay, my lines. This is the current S&P, right? This is the SPX, where we just filled this gap, so I can delete that gap because it's filled. There's a little one here yesterday.
When you and I did work together, we sort of felt that, unlike a stock, the S&P it's not necessarily as imperative that the S&P fills gaps the way individual stocks do. Do you still feel that way?
Totally on the SPY, but not on the SPX.
Fair enough.
And here's why, right? Because in the SPX, the trades, and you know what I mean exactly, but let me explain it to everybody else, because I think a lot of other folks won't pick this up as quickly. The SPX is an index of 500 stocks. So at 9:30, okay, in 0 seconds and 0 milliseconds, okay, everything opens. Within the first, split second, they end up printing their first print. Now, if some stocks have not opened because there's an imbalance between bids of, number of bids, number of asks, what they have to end up doing is that they have to end up, keeping the stock closed until there's an even number at a specific price that they can end up going. If there is no trade, what they will do is that they will actually keep the stock closed, and the print for that second will end up being the same price it was the day before. So in order to get a gap on the SPX, you see it's a lot harder to get a gap on the SPX than there would be on, an individual stock. And so these things tend to end up sticking around a little bit longer. Over the last 20 years, there's probably one gap every 2 years or so that doesn't fill on average. Here we had 3 up until a couple of days ago. We had 3 that hadn't filled in the span of 6.5 months. And so I just thought, that they basically had to fill, or at least some of them had to fill. I do think that these may be breakaway gaps. as I mentioned before, Andy, is that I had gone back and actually, I think we might have still been working together in my office when I ended up showing, 2014 is when I ended up showing this. But actually, it was early 2015. I ended up showing how this was the neckline over here. We got past it a couple of times. We came back. It had acted as resistance. Then when we finally got through and broke through it big, it came back and it acted as support. So I think this 2120 is, a pretty key level for us. I think that we do have some support down here at, so some major support at 2120.
It's awfully hard to be bearish when you've got world governments printing money and buying stocks.
It is. It really is. When and you take a look at, that's what's happened every sell-off, right? Every sell-off that we've had over the last few years.
True.
Okay. You come back and you take a look at, what happened, at each one of these things. The government stepped in. And they ended up saying,
Not just
okay.
one government, all government. Draghi was just on TV saying, oh, we got more. Having said that, I do want to say that, again, first year of a new president's tricky. And being a contrarian investor, a staunch contrarian investor, if I can't find blood in the streets or something totally unknown like this Aldera, then I'm not buying. That's
right.
Just my prerogative. So don't think for a minute I'm sitting here with a ton of cash looking to buy stuff, because I'm not. I'm content with what I have. I'm going to monitor it, and I'll steer the ship via shorting and not shorting or stuff like that. But I don't want to come across as suggesting that now's the time to jump in. There's some guy on Bloomberg News, you'll see a story go by. Your fund manager's decided now is finally the time to buy Apple. And he goes on to say he's never bought it before. I ask you guys, is that the guy you want to follow, the guy that's never bought Apple, and after it's gone to the moon, he decides, aha, this is the time? I don't think so.
Yeah,
That's the kind of fund manager I'm going to follow.
Yeah, I want you guys. While Andy and I were watching people going in and out of the Apple Store, we watched a video. Neither one of us watched Bill Maher, on HBO. But do a Google search on Bill Maher, iPhone 7. It was hysterical. It really was. It was very, very funny.
And he actually did a good job. It wasn't.
He did.
Wasn't his creepy stuff.
It wasn't his creepy stuff. Yeah. No, I'm not a big Bill Maher fan. I'm not a big fan of anybody who constantly has to end up putting down others. But it was hysterical. It really was. Anyway, so
one last thing, Jim.
I was going to ask you, what else would you like to end up saying before we end up closing? Because we've been going a little over an hour.
I know we're over, which is why I just wanted to say that, and I told you this at dinner the other night, I loved working with you. I want to work with you again one day. And one of the things we were going to do was to see if, and when Jim and I get together, like whenever we get together and we're in agreement, really special things happen. We have not been wrong. A question I had for him was, are his people satisfied only doing things with the S&P 500 index or futures, or do they are they interested at all in individual stocks, like doing option trades on individual stocks? You were sort of going to find out if there was interest in that or not.
Yeah, what we're going to do is right now I'd like you to guys write down about how many of you guys trade individual stocks versus indexes. And what we're going to end up doing is I'm going to end up asking Tom to end up sending out a survey, because what I've seen is that, I know that a lot of our services, all of our services focus just on indexes. There are a number of institutional guys that I end up working with Andy being just one of them, but a lot of them are almost all individual stock guys. Some of them are investors where they take positions. Andy, I don't know if other people have told you this, but I've seen you have relationships longer with stocks than I have you with women.
Yeah.
Okay.
Okay. As long as in the end they're more lucrative, it's okay.
Other guys are trading a more individual stocks?
I am an investor. I trade sometimes for sport, but I am absolutely an investor.
You're an investor. We shared one, and I don't have it on this computer, but we shared an options newsletter that goes out to institutional investors that goes on individual stocks. Especially around earnings plays and others. It's an institutional letter. It is only to EAB's clients. But what I'll probably end up doing is that as we're getting closer here, I'll probably end up showing you some earnings plays that come out of the newsletter. Some of them are just fantastic. And they're all quarter long, just not now. Finding a stock where the IV before earnings hasn't gone up compared to the IV behind earnings, to me is, absolutely great. Now, those types of things definitely give us an edge. I had several questions asked for the Kevlar. I don't want to end up covering them here. The Kevlar is a trade that we end up doing. What I will end up mentioning, if you want to end up signing up for the trial, I don't know if it's either $1 or it's free, but over the next 15 days, I'm going to be reviewing, the Kevlar through the Brexit. I'll also end up, we're going to be closing our current trade in October. We're going to be closing that probably within the next day or two. It has a nice profit as of today. I'm probably going to be reestablishing next month's October, and I'll also start to end up looking by the end of the 15 days to December. So if you're thinking about doing a trial on it, now would be a really good time. And I'll end up covering all of those questions during the trial. With that, Andy, thank you so much. I hope you end up coming back. I hope you end up coming back and talking to us about, different stocks and different things you're looking at. And everybody, if you guys are interested, please send me an email, with some of the things that you'd like us to take a look at. When it comes to doing research on stocks, a lot of Andy's usually my first call when I'm looking at individual stocks. So thanks again, and I will be talking to you guys soon. Thanks, Andy.
Thank you all.